where we're looking at a very uncertain economic climate globally at this stage, where many have coined the phrase a two-speed world, emerging versus developed, and where everyone wants to play for emerging markets specifically. To what extent is the fixation with emerging markets and frontier markets as well pushing things higher than they should be on the Kenyan market?
Thank you very much, Alishia. It's always a pleasure. Well, that's a good observation there, especially noting how the foreigners have been acting in our market. Well, looking at it from the Kenyan perspective, we've been seeing a lot of activities in terms of foreign direct investments, as even in terms of foreign investor participation on the stock exchange. And looking at it in terms of how active they have been performing, especially in the recent past, we're seeing them very interested in some of these very blue chip stocks like East African Breweries, Kenya Power and Lighting, and some of the other very listed strong banks like Equity. And because of that, it shows that there is quite a competition in terms of investment opportunities. But in terms of the return on investments, yes, emerging markets as well as frontier markets like ours are promising very good returns. Just as you noted there, people like Centum are still performing supernormal profits, which are a very good incentive for foreign participation.
I ask because the bourse is up 45% for this year and has flatlined since the referendum vote in the country. So what's your outlook in terms of performance of the index as we wrap this year up? Is the bull channel still intact?
Well, looking at it in terms of the bullish trend that we have been anticipating, well, most of us were very optimistic about us closing the year within the 5,000 mark. But looking at it in terms of how the corporate actions have affected the market, we are seeing a reduced activity in terms of the corporate announcements. And because of that, we seem to be hitting a bit of a plateau level. And we are already seeing a bit of a correction, looking at some stocks like Scangroup, Safaricom, which we hope to be able to be performing fairly well. And because of that, we seem like as at now, we are struggling to sustain it at the 4,500 mark. And as we're going towards December, the holiday season, we should not be expecting a lot of more activity as we now jump into the new year.
Let's hone in on Scangroup there, because it's the top performer at the Nairobi bourse, having posted 170% one-year return so far. And as you've highlighted, we've been seeing some correction on that share price over the recent past. Do you have a position here? Are you buying or are you just holding?
Well, looking at Scangroup, yes, we had gotten to a position whereby we were encouraging a lot of investors to take profit, because looking at it, especially in terms of the price to earnings ratio, it was already looking a bit of a price. And we had even discussed here some time back, and we were saying basically looking at where it is now, it would be a cautious buy. But looking at it in terms of profit taking, it was a very good strategic opportunity, and we encouraged people to get out within the 68 to 70 range. And as at now, as it's struggling to get a new support level, it's a very promising stock, especially looking at the positioning in terms of the coming years and the future of the stock. And as at now, hopefully if it can come below 50, it will still be a very promising buy.
In the meantime, TPS Arena has posted 108% one-year return, and many saying this is the proxy for playing the tourism sector specifically. What's your assessment of prices relative to fundamentals right now on that front?
Well, TPS definitely is a good stock, especially noting that some of these stocks are a bit cyclical because of the fact that they depend a lot on the economy, political climate, as well as some of the favorable things about the tourism sector. But TPS, looking at it, especially post-rights issue, they have been very well positioned to expand and to grow in the region. And because of that, their bottom line is definitely promised to be able to perform in terms of growth. And looking at them in terms of how the share price has been going, well, the demand has been very strong on the stock, and hopefully it will be able to still support in terms of the management of the company, as well as some of the returns that's going to be able to bring in terms of the corporate actions. But looking at it as at now, it looks a bit of a worrisome stock because it has really been going up, and we hoped basically after the rights to be able to dip slightly because of liquidity of the stock. But because of that aspect has not really been there, and the demand that has been very strong, especially looking at it in terms of the positive outlook of the tourism sector, it's a bit of a promising stock, but a very cautious buy as at now.
Very quickly, on the flip side, we've got Safaricom here. While it's been amongst the most active shares on the NSE, it's at 4 shillings 55 on a trailing PE of 11.8, and still being maintained is that price looks oversold. How much more room do you see this price having to run?
Thank you very much. Well, Safaricom has been one stock that we've been monitoring for quite a while, and we have been optimistic that it will be able to at least sustain itself above the issue price, the IPO price. But looking at it in terms of what has been happening in terms of the price wars and such other factors that have affected it, and the trailing PE of 11 being an ICT stock and hopefully a promising future, well, as at now, as you noted there, the price is a bit of a concern because the second half of the year does not look as promising as the first half, and because of that, but we are seeing as though it's going to be able to get a bit of a support at 455, but as at now there are concerns that it might even dip to 420.